Once again, thanks for tuning in. Holly Shields here for Kalkinemedia. Let's explore the different forms of dividend payments. But before we get into it, please give our channel a sub and hit that bell icon to stay ahead of the game. A company pays out a dividend from earnings as a return to shareholders. It's at the company's discretion whether dividends will be paid annually, monthly, or quarterly. It depends on the dividend policy. A company has various ways of paying out dividends. Dividends can be paid out as cash dividends, stock dividends, property dividends, scrip dividends, or liquidating dividends. So, what are cash dividends? Well, cash dividends are the most visible form of dividend payment. They utilize the company's cash for payout. The board of directors passed a resolution to pay a certain dividend amount in cash on the dividend declaration date. It's payable to those eligible investors who hold the company's stock on a specific date, often the record date. The record date is when dividends are assigned to shareholders. On the payment date, the company issues cash to shareholders as dividend payments. It's by far the most popular form of dividend payout. The money shelled out is deposited into bank accounts of shareholders. The shareholders are paid in cash as per their shareholding on a per share basis. Only companies having positive earnings or cash flow can distribute cash dividends. What are stock dividends? Well, when a company issues an additional share to existing shareholders for no extra consideration, it's called a stock dividend. A company often issues this type of dividend with low operating cash available but still wants to satisfy investors. Each equity shareholder in such a case will receive a certain number of additional shares based on the original shareholding. For the company, the number of issues shared in existing capital base will increase. Since there is an increase in the share capital, it will adjust the market price, EPS, DPS as well, and other metrics based on the share capital accordingly. If a shareholder desires cash returns, they can sell the stock in the secondary market for cash. This is termed earnings capitalization. If the company issues below 25% of the existing outstanding shares, it's termed as a stock dividend or a stock split. Retained earnings are utilized for giving this type of dividend. What are property dividends? Well, they're another form of non-monetary dividend paid to shareholders. Property dividends are recorded at the current market price of the asset issued as dividends. Often, the market price of an asset is either above or below the book value. Therefore, property dividends either incur profit or loss depending on the book value entered. The distributed asset could be anything like inventory, equipment, vehicles, or any other asset. So, what are the advantages of paying dividends? Well, shelling out dividends has various benefits for the shareholders of the company. Some of them are the following. Investors are attracted to companies that pay regular dividends. Thus, any dividend holds the investor's interest in the company even if it is going through a comparatively rough patch. Investors like stability in dividends as it assures them of a reliable source of earnings. It's beneficial even when the market price of the share dips. It's good for investors who are looking to earn quickly and not wait for returns. Dividend payments ensure investors receive some money and do not have to wait for share appreciation. Stability in dividend payments portrays a positive image for any company. Investors prefer to have a stable, regular dividend, and it provides a kind of predictability towards the company's earning capacity. So, what are the disadvantages of dividends? Well, while dividends are so beneficial, they also have a few drawbacks. Regularity needs to be maintained. If a company wants to maintain investor interest with dividends, regularity in dividends becomes essential. If in between companies are unable to pay dividends for some time, it may lose a few of its investors. When the payout ratio is high, the retention ratio automatically decreases. Dividend payments decrease the cash available to businesses. Thus, not enough cash is left to fulfill unexpected obligations or expenses that can arise at any time. Dividends limit a company's growth earnings. which are paid out and not reinvested into the business. Well, now that you're up to speed, check out some of our other videos to boost your financial IQ. If you like this info, please give us a like, share, and a comment, and head to our website at kalkinemedia.com for regular updates. Holly Shields for Kalkinemedia.